This is clearly the best time to invest in real estate investment trusts or REITs in decades. With this video, I'm going to show you why. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. And what I'm going to look at here, I've put together a portfolio, if you will, through the FastGraphs fundamentals analyzer software tool of what I consider to be mostly some of the most attractive REITs available today. But I want to point out before I show you these that it's a market of stocks and not a stock market, as I often say. So even though REITs in the general sense have become more attractive now, that doesn't mean all REITs are attractive. What really matters are fundamentals matter, and they matter a lot, and I'll be explaining that. So let's go ahead and get into FastGraphs, and let's look at the REITs that I found that I think are attractive now, and I'm going to talk about why they become attractive, and I'm also going to show you some REITs that I don't think are attractive, even though the valuations look very low. So let's go ahead and get into it. This is a portfolio summary where I've created a view of 28 REITs that I've put together. Now, about 23 or 4 of them are REITs that I consider to be attractive today. Okay, but there's several here that I'm using just for teaching moments, just to illustrate examples of how it is a market of stocks and not a stock market. It means that all REITs are not the same. And there are some REITs that are very attractive now, some REITs that are not attractive at all, and some REITs that are still even overvalued. So we're going to look at those. And what I'm going to generally do is go through this in alphabetical order to start and just show you what's happened to REITs and why I made the statement earlier that this may be the best time in decades. So let's start with Avalonbay. And I'm going to go through the fast graph to operating cash flow, which illustrates funds from operations. Now, this is going to be a high-level video because I'm going to be covering a lot of companies here. So I'm not getting into a lot of, the nitty-gritty research. I'm just going to basically be talking about what is clearly evident on the fast graph as I'm looking at it. So when I look at Avalonbay, I see 2 valuation reference lines. I see the normal 15 multiple line that I like to hang my hat on. I think that's generally a good valuation reference. And in the case of Avalonbay, I've also got the normal price to FFO, or the average valuation that the market applies, and I want you to notice that's a lot higher. So the market has generally liked to value this particular real estate investment trust. Now it is A- rated, does only have 39% of debt, and it does right now generate about a 4% dividend yield. But at times when the price was a lot higher, we only had yields of like 2.9%. And even when the peak valuation, it was only 2.5%. So my point being is that this has generally been an overvalued REIT. And as a consequence, I don't necessarily think it was an attractively priced REIT. But in the Great Recession, I want you to notice the price corrected down to below that 15 price to FFO orange line. But then it stayed fully valued coming out of that. COVID brought it back there again. And right now, with the rise in interest rates, we saw Avalonbay come from a very high, multiple of almost 30 times funds from operations, down now to where it's currently trading at just over 15.7 times funds from operations. So, I would still consider this one slightly overvalued, for my taste, but you can clearly see why I said in my intro that this is the best time in decades, because generally you had to be willing to overpay if you wanted to invest in this REIT. The next one we'll look at here is Camden Property Trust, and we saw a couple of special dividends being paid. That's why you see this spike in the white line. But once again, we have a 15 price to FFO and a normal 18 times FFO. Now I'm going to shorten the time frame a little bit here. And, since beginning of 2011, this stock has wanted to trade at around a 19 multiple. Again, today we can buy it at a 12.78 multiple with an FFO yield of 7.8%, one of the highest it's had, and a dividend yield of 4.6%. And I do want to point out that excluding the special dividend, this company has raised its dividend consistently year after year. Again, it's an A- rated rate with under 40% debt. Interest rates, have brought it down. Now, I want to make a point here because I'm going to talk about this more a little bit later in the video, but people respond to the stock price. They always ask, what's wrong with the stock if the price falls? And I also tend to love stocks when their prices are rising. But I want to make a point. If I look at it in, January 8th of 2021, when it was trading at a 19 times FFO, compared to, just less than a year later when it's trading at 33 times, I did have some decent growth here. I had 10% AFFO growth. But then in 2022, my growth doubled. It went from 539 in FFO to 659. That's a 22% increase versus a 10% increase the previous year when the stock was rising dramatically, and yet we saw the company's valuation drop by a rather substantial amount. I'm not going to get it perfectly here, but it dropped by over 40% in 2022. I'm going into 2023, but generally 2022 was a bad year, yet it was one of their best years. The point I want to make is I trust FFO or fundamentals way more than I trust stock prices. I think anyone with common sense would recognize that this REIT, the valuation did not change this much, especially on the downside when the company's performance actually increased dramatically, and yet it doesn't make any sense. Moving on, let's go ahead and look at CubeSmart. This is a self-storage REIT, and I want you to note the market has always liked to price, it has historically liked to price this at a very high valuation. Interest rates have brought it down to one of the more attractive valuations in the last couple of decades that you could have bought this particular real estate investment trust. It's yielding over 5.4%. It has an FFO yield of 7.31%. And again, it's a high quality REIT in the self-storage market, which has been a hot market, as you can see, for years. But the market is not always correct. That's what I want to get across. Now, I'm going to skip this REIT here temporarily and come back to it because it's a very important lesson that I want to talk about in terms of valuation and fundamentals. But let's move on to Digital Realty. Now, this is an extremely high quality REIT, BBB rated, less than 50% debt. And keep in mind, REITs typically buy real estate and they usually have mortgages on those real estates, just like you and I do on our homes. Okay, that's the way REITs work. They buy real estate and then they, use that leverage that they get from borrowing money to buy the real estate so they can increase their rates of return. And once again, Digital Realty has been just ridiculously priced by this market. But I want to point out it was ridiculously priced by the market for all those years. And even when funds from operations dropped in 2020, the stock continued to move to all-time highs. So it's not always logical how stock prices are reacting to fundamentals. But what I'm pointing out here is this stock then got very inexpensive in October of 2022, rallied a little bit, got inexpensive again in April of this year, and now it's rallied again to where it's overpriced. If I would have been buying Digital Realty, it would have been during these two periods here. I think it's a little pricey right now. It's still a very high quality REIT. I still like it. I could probably still make money buying it here. If I go into forecasting, just to make a point, and it traded at 15 times, I would lose money. But if it traded at its normal multiple of 18 or 19, I could make 7% a year. So even though it's technically overvalued by my traditional methodology of valuing stocks, I want to see it at or below this orange line. It's still possible if it goes ahead and trades at a higher multiple than, like the market has historically wanted to apply, you could still make money. But this is all about investing with your eyes wide open. The stock is definitely not cheap relative, to what it was back here in 2013 and 14, and even what it was in 2022. And of course, once again, even at the beginning, the first 5 or 6 months of 2023. All right, so moving on from Digital Realty, let's go ahead and look at Essex Property Trust. Now, this is a classic example of a REIT that has been trading at a very high valuation. Lower interest rates have brought it down, but I want to make another point. Lower interest rates, this is a company that's average growth has been 5.64%. If I look at forecasting, growth is expected to be only about 2.6%. Long-term growth, however, is expected to be the 5.71%. So in other words, although they're expecting a flat year, a 4% year and a 2% year last year versus a 16% growth year in 2022, the stock now, or the REIT, has now become an evaluation offering a 4.5% dividend yield. That makes it look very attractive. It's a BBB plus rated rate with only 53% debt, which I think is very manageable. And as you can see, their cash flow simply, is covering that. If I go on and look at extra space storage, I think this is a really classic valuation. Now, what I want to make a point here again is I think the market should be valuing this at around 15 times FFO. The market has valued it at 21 times FFO to almost 22 times FFO or higher. Okay, so this REIT has, if I just run my mouse here, you can see these multiples of FFO, popping up here on the screen. And, there was, rarely was it below 19 and almost never got down to the 15. It was 15 or below 15 FFO in 2010. Now, this was clearly the best time to buy this REIT in the last couple of decades. But today, once again, we've got a blended FFO of 14.47. Back here, the FFO got down to 11. And by the way, it did get down to 11 or, actually 12.8 in October 27th of this year. So, you want to buy low so you can sell high. So the REIT is expected to have flat growth going forward. So I do want to make that clear. But the point is the rise in interest rates have brought this REIT from stratospheric nosebleed valuations down to valuations that are starting to make a little bit of sense once again. Now, I want to look at Federal Realty Investment Trust. This is another one the market just loves. Now, there are analysts who would point to this, and they'd point to this line as being, what the REIT would be going to. I don't think it's ever been worth more than 15, and consequently, I have not owned it. And, we saw what happened during COVID. This is a retail REIT, and, they had a lot of their retails had to close down. But once again, we see the effect that rising interest rates have caused people to sell these stocks and bring their prices back down to reality. And again, I'm just doing a high-level look. Now, I want to look at Franklin Street Properties because I mentioned earlier, just because the valuation is low, this sells at the lowest valuation of any I've looked at, 6.9. We'll call it 7 times FFO, half the valuation that most of the REITs I've shown you so far. The FFO yield is over 14%. The dividend yield is 1.89%. Okay, but I want you to notice that in this case, interest rates I don't think had very little to do with why this REIT is down. This REIT's fundamentals have simply been deteriorating over the years, and the stock price has clearly followed that ever weakening amount of funds from operations. And this is an office REIT. And we all know what's happened since COVID, but I want to point out this office REIT was showing weakness even before COVID actually hit. And of course, COVID is where everybody started working at home, and then that exacerbated the problem, and the drop in growth accelerated. Instead of dropping at 8%, earnings or FFO was dropping at 26% per year. So this was clearly a case of a lower valuation. We have a Mid-America apartment communities here, multifamily residential. A 15 to 16 or 17 times FFO has always been a really attractive valuation reference. Now, I'm going to talk about what I mean by valuation reference. Clearly, you could have bought this stock at a 19 times FFO, and even at today's low valuation, still made almost 5% a year. Okay, but what high valuations do is they reduce your ability to participate fully in the growth of the company. And obviously, if you paid high valuation, even if you bought it here, even though the stock rose dramatically over the next few months, if you still held it today, you'd be losing almost 9% a year. You'd have turned $10,000 into, just over $7,000, and you got about $700 in income, so you still had a negative 8.89% annualized rate of return. Valuation matters, and it matters a lot. But this is an A-rated REIT, A- rated, with 38.57% debt to capital. And what's interesting about it is it's been a very consistent performer, and you can now buy this REIT. This is a classic example of why I'm saying. But once again, I want to point out the value of this company, the intrinsic value of this company did not change by this much over this 3-year period of time. You've got to be willing to understand and recognize the fact that the market has been wrong about the ways they've been valuing this stock in the past. And there's been times when they've been very right about how they're marketing, but you can't just assume that the market's always right, because clearly the stock was not worth this type of multiple just a few months ago. If I move on to Macerich, here's another one where you have deteriorating fundamentals. It isn't interest rates that have brought this REIT down. It's the fact that the fundamentals of this REIT have not been doing well. Now, Here I'm going to go into another thing for you. I did a video about MPTW a while ago. And one of the things I pointed out, and I've said it was actually the title of one of my videos, I said, what has really changed? Now, the fundamentals did deteriorate. Now, I want you to notice there was an explosion in fundamentals, or FFO growth, from 2019 through 2022. And then we had a drop, but this was still one of the highest FFO achievements the company had ever made. $1.55, you have to go back to 2020 or they earned $1.57, and then prior to that was in the 130s. They did decide to cut their dividend. I didn't think they needed to, I didn't think they should have, but they did. But here's the point I want to make. The fundamentals of this company did weaken, but what really changed was the stock price dropping. And the stock price fell much more severely than I believe the fundamentals dictate. And going forward, the fundamentals of this stock still look pretty attractive. Now, we're showing the dividend cut, but I want to look at the forecasting graph here and make a point. They have shown weakening. 6 months ago, analysts were expecting $1.57 for Medical Properties Trust in 2023. 3 months ago, $1.44. Now, they've actually increased that. There's actually been a slight improvement. And the current consensus estimate is $1.55, which is better than the $1.54 that we saw 3 months ago. But now, here's what I want to point out about nothing's really changing. Assuming this gets to a 15 multiple, and let's test that. Let's look at the back test historically. We can see that the market has, historically put a 12 and many times a 15 multiple on the stock. If I go back to the forecasting graphs, and I even look at the normal multiple, which has been around 12, okay, and I look at the fact that, the multiples actually increased a little bit. If I look at the 6 month ago multiple by going up here and clicking that, notice how that line rose a little bit. Well, that would tell me that I could make 112% if the stock earns what the analysts are expecting now, and if it only trades at a 12.3 multiple. I could make 112% annually. That would turn 10,000 into 46,000 in just a 2-year period. This is why I'm holding on to the REIT. 3 months ago, that dropped to $1.50. So if I do the 3 months ago, now if I point to this and instead of 120 some, it's 109%, I'm still turning 10,000 into over 45,000 in just a matter of a couple of years. Now, if I go to the current number, which again has increased a little bit, so if I go to the current number, I'm looking at 108% going forward annualized, turning 10,000 into 44,000. And that's, showing a less than 6 months ago, but more than 3 months ago number. Now, the number has weakened even more for 2024. So, went from $1.59 to $1.46. So here, looking at the current estimate of $1.46, which is the lowest in the last 3 or 6 months, I'd be looking at making 284% annualized. But that's a, 339% growth. And, that's giving me a very powerful number plus dividends. And the dividend yield is currently around, somewhere around 10 to 14%. It's hard to figure because, this data comes in a little funky, especially when they've cut dividends. But if I look at, 6 months ago when the numbers were at 159, I want you to notice the previous was 146. And so going to the 159, I'd be looking at making 313%. So if I look at the current, I'm looking at making 284%. Nothing has really changed. Okay, I want to make that clear. But let me make another point now. Let me look at some other REITs here that I've got on this list just to give you some perspective. If I look at DHC, the one I flashed up earlier, okay, this is Diversified Healthcare, another healthcare-related REIT. This is what I mean by something has changed. I'm not really talking about the price. I'm talking about the fundamentals have completely deteriorated. So did the dividends. Now, this company may recover. It's slightly being expected to recover. But this is where the price and the fundamentals fell in tandem in a reasonable relationship to each other. Now, this company was going to basically merge, and they called this merger off with another company, another REIT called Office Properties Income Trust that also had deteriorating fundamentals, and they called that off. I don't know why these two REITs would want to merge. It seems to me like they'd just be expanding their losses. But anyway, make a long story short, it didn't happen, and DHC, called that off, and then the stock price, has been floundering. Now, the market is surging today. So if I go to Yahoo, pricing here, it's up almost 9% today. But I also want to make this point. If I go to Medical Properties Trust, the one that, I've been getting a lot of criticism on in the comment sections, Medical Properties Trust is up almost over 14.5% today. Okay, now I want to make a point about this, and I want to make this point very strongly. Medical Properties Trust, it's inconceivable to me to think that this stock increased by almost 15% from yesterday's close of, $4.08 to today's valuation of $468. That's a 14.7% increase. That didn't happen. Stock prices lie. Now, what do I think this stock is worth? I think this stock is worth $17 or $18 a share. Now, I also want to make another point. If I go to Morningstar Research here, okay, and look at what they give for fair value, Morningstar gives a fair value of $7.59, okay, significantly higher than the stock is currently trading at. And the point I want to make is that $7 or $8 a share, I think, is still under what it's worth. I think it's worth more like $15 to $20 a share. And now that they've reset this dividend, I expect this dividend to hold, and I do expect, to receive a nice chunk of income while I wait for this stock to recover. But, the stock fell like this before by 34, the FFO, the fundamentals fell in the past, and the stock actually rose in value. Okay, so again, we got a 15% increase. We got a strong market today. It's really hard to say what's going to happen. And I don't think this one day of being up 15% has changed anything either. I think the stock is cheap. I think it's eventually going to recover. It may drop again tomorrow after, rising so strongly today. Nobody can predict the short-term change in market prices. Going on, we look at NNN REIT Inc., BBB plus rated. We see very high valuations. More recent years, the valuations have gotten attractive. Yields almost 6%. I think this is the best time to buy REITs. Looking at National Storage Affiliates, a self-storage REIT. Self-storage REITs were very hot. They traded at 20 multiples of FFO. Again, I don't think their growth warranted more than a 15 multiple of FFO. You can now buy it today at 11.24 with almost 7.5%, 7.44% dividend yield that's been increasing nicely. So, here's another one, Nexpoint Residential Trust. This is a multifamily residential. We know home prices are dropping a little bit. Interest rates have an effect on that. The analysts are expecting a flattening, but I do believe the price reaction is twofold here. It went from being way overvalued to reasonably valued, and now it's fallen to be very undervalued based on what forecasts are looking at. Now, we're not looking at much growth for the next couple of years, and we're not getting a long-term growth rate. But, as interest rates stay high until mortgage rates start coming down, that may be the truth. But again, we're looking at a company now that has good potential because of valuation. Valuation matters, and it matters a lot. Moving on, I covered Realty Income. I did a full video on it. You can, check that out if you like by going to my channel. But again, it's one of the best times to buy Realty Income. This is the monthly income REIT, A- rated, one of the highest quality REITs in the world, pays monthly income. It's a dividend aristocrat. Dividends have increased, every year since the company's been going public. And I do want to show you something. By the way, if I'd have bought this stock here, if I look at performance here, okay, and I look at it from the standpoint of how it compared to the market from January 2nd, 2009, I want you to notice that dividends were more than twice, the income if you're an income investor. Capital appreciation was about half of what the market was. But I want to point out that the market is massively overvalued now. But if I go back to this historical chart and I look at valuations when valuations were high, if I run this like a 9-year graph, okay, now I look at performance and I find out that, the market, it did half as well as the market, but yet it still produced almost twice the dividend income of the market because REITs are typically high-yielding investments. That's why people invest in them, and this one has continuously increased their dividend over time. Now, another point I want to make is, before I leave Realty Income, is if I go in here and using my fast graph tool and reinvest the dividends, okay, now I compare performance reinvesting the dividends, remember I had a dividend advantage, I would end up with a higher rate of return than buying the SPY and reinvesting the dividends there. I would have gotten $40,000 in dividends reinvested versus $8,696 in the S&P 500, turning my total $10,000 investment into $71,000 versus $57,000. Because of the income advantage of REITs, if you're reinvesting them, you can still generate a significant amount of growth by investing in real estate investment trusts, especially if you buy them at attractive valuations. Now, even if you overpay for the REITs, like, you could have here, I didn't hit the perfect top on purpose and held it to today, you still made 4.5%. But again, most of it came from dividends. Your 10,000 would have increased by 370, but you'd have got $5,499 in dividends. It was the dividend that would have given you the rate of return here of 4.5%. And the valuation mitigated that, all right? So I want you to be aware of that. Valuation matters, and it matters a lot. Omega is another healthcare REIT that I think has been undervalued for several years. Interest rates haven't really changed anything here much. If I look at Prologis, I get a case where the market just got really enamored with the stock. This is irrational exuberance, hype, and hysteria as far as I'm concerned. I don't think the REIT was ever worth this. That's one of the beauties of fast graphs. It has your eyes wide open. Anyone who's buying this REIT during this time should have been cognizant of the fact that they were paying a premium valuation to invest in this REIT. Okay, if I shorten the time frame here, you can see that a 24 multiple was real. The market did apply that, but now it's fallen significantly below that. It hasn't got down to the 18 yet, but again, buying it even at these high multiples here would have given you a 4.9% rate of return, because this is a very fast growing REIT relative to most REITs. But if you could buy it somewhere near fair value, I didn't hit it perfectly there, and hold it to now you're all of a sudden participating fully in the growth of the business. That's what valuation is all about, in my Mr. Valuation's opinion. So I'm just going to go through it further, quicker here now. You can see, how these REITs have really come into fair value. They're moving into fair value. Here's SBA Communications, Telecom, Tower REIT. The Tower REITs were very highly valued. We now see it. You can buy it at a reasonable valuation, maybe the best time to invest in them. Get almost a 1.5% yield. It's still trading at what I would consider to be a high valuation, but it is a very fast-growing REIT. Tanger, factory outlet malls, obviously suffered through COVID. They had to literally shut some of their malls down. They cut their dividend. But look how the REIT has rallied as fundamentals have improved over time. This one is not really being affected by interest rates at all. Simon Property Group, in a similar situation. We've seen a strong rally coming out of COVID, but it is trading at a big discount to its fair valuation. Stag is a very consistent REIT, 6% grower, 43% debt. This is not the best time to buy it, but it's certainly an attractive time. Had you bought the stock back in January of 2013 at a 14.7 multiple, which is close to the 1504, and held this REIT that's grown at 5.67%, you end up making just under 10%, because you got 6% growth, which is very close to what the company has achieved. That's just a little bit of PE expansion, but you also got the dividend income, which pushed you up to almost a 10% annualized rate of return. This REIT, once again, looks very, very attractive. Here's Sun Communities, a single-family resident REIT, another one, trading at high multiples as interest rates have definitely had an impact here, but it's now becoming reasonably priced if you were going to invest in it for the long run. And then UDR, which is a multifamily residential REIT, is another example of a REIT that was trading at very high multiples. The rise in interest rates have brought it down into a reasonable multiple. And then I'm going to end here with VICI Properties, or VC Properties. It's a specialized REIT, but it's also a experiential REIT, they call it. That's an experience. They own, Caesar's Palace and other big, properties like that. But now I want to talk about using the tool correctly with this REIT. And I'm going to end the video here. What I want to point out is when the REIT went public in January of 2018, it came out at a period of time where the FFO grew by over 653%. Well, that's aberrant. So you would have to trim this, okay, and come up with a reality that this is about a 7% grower. Looking at it, forecasting 4.5%, long-term growth 15%. So, you've got growth here, 5% growth next year versus 4. But, we can buy this stock at a 13 multiple, an FFO yield of 7.5, and we can get almost a 6% dividend yield that has also grown very nicely by over 10% a year since the company's been public and been paying a dividend. So this one looks very, very attractive as well. BBB minus rating with only 42% debt. Anyway, this has been Chuck Carnevale, co-founder of Fastgraphs Fundamentals Analyzer software tool. I do want to apologize for this long video, but this was my take on REITs for you today. There's been, everyone thinks automatically it's all about real estates, but, I've read different studies indicating that interest rates will have less than a 15 or 20% effect on how REITs can perform. They still can manage their money, they still can borrow money, they still, adjust their rents and their, distributions based on what the current state of the economy is, like any good management team is. But if you were going to ever invest in REITs, now might be one of the absolute very best time. They're primarily income vehicles, but even if you're looking for total return, as I showed in the video, if you reinvest the dividends, REITs can also give you some really good, accumulation or building of wealth over time as well. Hope you enjoyed this video. I apologize for the long length, but I did feel like this was an important subject, and I did want to cover it as thoroughly as I possibly could. If you enjoyed the video, ring a bell, give me a like, and subscribe to Fastgraphs. What a wonderful tool to keep you grounded so that you're always investing with your eyes wide open. Thanks for watching.